Welcome to this week's episode of Financially Speaking. As a local family-built firm, Bushka Retirement Solutions, along with its affiliate companies Bushka Wealth Management and Legacy Tax Solutions, offer one-stop retirement, tax, and legacy planning services to families nearing or already enjoying retirement. Sue Bushka is president of Bushka Retirement Solutions, a retirement planning company helping develop financial, Medicare, and health insurance strategies. Over a decade ago, she partnered with her son, Cole Bruner. Cole, an investment advisor representative that's held to a fiduciary duty, is president of Bushka Wealth Management, a fee-based registered investment advisory firm providing financial planning and investment management for individuals and businesses. Legacy Tax Solutions offers personal and business tax planning and preparation services. Their enrolled agent, Carl Van Setters, is a military veteran with over 10 years of accounting experience and is committed to maximizing your tax credits wherever possible. Over the last several years, Sue and Cole have continued to grow their team of private wealth advisors to meet the increasing demand of retirees seeking guidance. In 2018, Ryan Connor began serving clients at their Eau Claire location. At their Wausau location, Logan Wooler became a part of the team in 2020. And in 2023, Sue's daughter Kaylee Berenson joined the firm. As a family-built firm with offices in Wausau and Eau Claire, their dedicated team of professionals have the experience to provide custom-tailored strategies to help you achieve your long-term financial goals. The next 30 minutes will be filled with retirement information presented by their team in a simple manner that you can understand. So stay tuned because Financially Speaking starts right now.
We're going to go into a topic called global finance and economic trends.
In this episode, I'll discuss how you can potentially pay fewer taxes on retirement account withdrawals.
Today, Ryan and I are going to be talking about what to do with a large inheritance.
And now for our weekly question and answer segment.
Welcome back to Financially Speaking. Today I'm here with Cole and Logan from Bushka Wealth Management and Bushka Retirement Solutions. We're going to talk about some questions that you all have about preparing for retirement. But if you'd like to see a question answered on a future segment, please email us at info@retirewithbushka.com. Cole, Logan, thank you so much for joining me today.
Yeah, for sure.
We're going to go into a topic called global finance and economic trends. Very fitting post-election. So, Logan, we're going to start with you. How can our audience stay informed about the global economic trends?
Yes, so it's going to seem like an obvious answer, but just watching the different news outlets out there. The thing I would say is just double check that. And make sure you're looking at different news outlets because you see certain things said a certain way on one channel, phrased a different way in another channel. So looking at that, but then also signing up for some of these different articles that come out weekly, monthly, and then simply looking at how the trends are reacting as far as what's unemployment rates, what's housing rates. But really all just stems from the World Wide Web, the internet there.
Yeah, and I would say to kind of piggyback on that, I mean, obviously know your source of where the information is coming from. Maybe be a little speculative of information on social media. I feel like a lot of people do go to social media for their news updates nowadays. And although that can work, I mean, there are a lot of outlets that do put out factual data on social media sites and things like that, but maybe not use it as your only resource for getting updates and news. And the other thing I would say is working with a financial professional. I mean, obviously, as financial professionals, we have to be aware of all of these different things that are going on globally in terms of finance and economic, economic changes and all of that stuff. And so just working one-on-one with a qualified financial professional, I think will really help to maybe reduce some of the stress of needing to know all of that stuff yourself. If you have a quality relationship with your financial professional and they're guiding you through those different things, then it's certainly not something that you have to be an expert on. And we tell our clients that all the time. I can't tell you how many times clients come in and they're like, how do you know all of this stuff? And it's like, well, it's what we do. It's no different than I couldn't walk into your place of business and do your job. There's a reason reason why I don't change the oil in my own car. I could probably figure it out after watching 2 hours of YouTube and getting all dirty and probably mess it up and have to pay somebody even more to fix it. Or I could just take it to the professional that's going to get it done in 15 minutes, and I pay a little bit of money, and it adds value to my life to not have to do all of those things. So I think that's part of it is, knowing what's going on and knowing where to get that information, but also knowing that you don't have to be necessarily an expert on it if you're working with somebody that you trust.
Well, let's continue that conversation, Cole,
Sure.
because I would like to know, what do you think are the ways that global events impact our viewers' finances?
Well, it really, we are an interconnected globe nowadays. Obviously we're in the United States and there's all these various different countries that are doing things differently with their economy and their politics and all of that. But at the end of the day, it can reflect back on our portfolios and different things along those lines. If we're invested in foreign countries and there was, a war that broke out or something along those lines, we do live in a time period where we have global conflict, global economic downturn, all of these different things, and it affects different areas of the globe differently than others. And so understanding that we are in a very interconnected world, and we're also in a world where information is readily available. It used to be that when you wanted to get your news updates, you had to turn on the physical news. And now if something happens, 2,000 miles away, within minutes, I have an alert on my phone telling me that it's happening, and that can maybe also be a little dangerous sometimes because people often will act on that information. So if something happens across the globe and people are in their portfolio trading or whatever it might be, well, maybe we don't want to knee-jerk react to some of that stuff. Maybe we want to take a look at the broader picture. Again, work with a financial professional. Theme is pretty common here, but nonetheless, it will help take some of the stress off of you to determine, should I be acting on this information? Maybe it prompts a phone call to your financial professional to say, hey, I see this is going on. Is this something that I need to act on? Is this something I need to change my portfolio due to? Or maybe that's already happening behind the scenes if you're working with a portfolio that's actively managed.
Very good. So there are some risks and opportunities, you would say, in investing in international markets. Logan, do you want to talk a little bit about what those risks and opportunities are?
Yeah, so starting with the risk, as Cole had mentioned, if there's conflicts overseas, if there's wars, that could impact some of that global trade. Because we don't produce all of our goods that we need here just in America. We're buying grain from another country or wood from another country, oil from another country, and vice versa. So it's really looking at those tendencies of where we're getting the products from and if we should be investing there, because if there's a world conflict, let's say with the Middle East, well, that may change oil prices. So there's going to be risks there as it relates to what they're exporting and importing, but then also looking at how those economies are moving too. If we can think back to the COVID times, if a country shut down because COVID was spreading, well, maybe we don't want assets in that country or in that market because it's that snowball effect. That market's shutting down, the economy is going to be impacted, so then your money will be impacted. So there's going to be a lot of risks when it comes to the international market, but there's also going to be opportunities. We've seen the American stock exchanges perform a bit better than the international exchange markets, but there's still opportunities over there for pretty much the same reasons I said, but now thinking on the positive sides of them. If we're going to have a new initiative as a globe of maybe focusing more on green energy and things like that, well, maybe we'll invest more in what's going on in the country overseas that's taking that initiative. So it's really just going back to understanding what the trends are and what the globe's got going on, essentially.
Yeah, exactly.
So Cole, how can our viewers diversify their investments to mitigate those global risks?
Well, obviously we preach in our office about having a portfolio that is actively managed. We always believe that if your portfolio is being overseen by a team of professionals that understands your goals and your wants and your objectives and can adjust the portfolio accordingly, then it takes some of that stress off of the client to have to worry about, should I be investing in China because of this or that, or should I invest in Europe because of that? It takes some of that weight off of your shoulders to, again, have those meaningful conversations with the person that you trust with your life savings to say, hey, I'm seeing some of these things going on. What is your perspective on that? Or are there things being done within the portfolios already that are helping us to either protect against this risk or take advantage of this opportunity or whatever it might be? So I think working with a company that's going to be actively monitoring and adjusting your portfolio allocation as the landscape of the global market changes, I think is where you're going to get a bit of value in at least having the peace of mind that somebody's watching out for that for you.
I love that. Well, thank you both very much for answering all of our questions today
Of course.
on this topic. And thank you all for joining us. We'll be back with more right after this.
The Tax Cuts and Jobs Act of 2017 reduced income taxes for many American households, but many of those provisions will expire on December 31, 2025 if Congress doesn't act. That could mean that you'll pay higher taxes, but you can take more control of your retirement by prepaying some of those taxes now at the current rate. Call us at 715-355-4445 or visit retirewithbushka.com for more information.
And now, our Financially Speaking weekly topic segment.
Welcome back to Financially Speaking. I'm Ryan Connor from Bushka Retirement Solutions and Bushka Wealth Management. In this episode, I'll discuss how you can potentially pay fewer taxes on retirement account withdrawals. Reliable income is one of the most important parts of your retirement strategy. Now, this goes hand in hand with the strategy for limiting your taxes on retirement withdrawals. A U.S. News and World Report article titled "How to Pay Less Tax on Retirement Account Withdrawals" has some excellent insights. Let's go through the article together. First, let's talk about early withdrawal penalties. The first piece of your strategy should be avoiding early withdrawal penalties. If you begin taking money out of your traditional 401k before you reach age 59 and a half, you could be staring at 10% early withdrawal penalties. Essentially, you're just giving a chunk of your money away. However, if you leave the job linked directly to that specific account, you may be able to begin penalty-free 401k withdrawals when you turn 55. Additionally, it may be possible to avoid IRA early withdrawal penalties if you use the money you take out for an approved expense, such as medical bills, college costs, or buying your first home. On the flip side, you can take withdrawals before they are mandatory without incurring a penalty. If you reach the age of 59 and a half and you discover that your distributions would be taxed in a lower bracket than you will likely be in at age 73, you may want to consider taking some withdrawals before they are required. Now, if you take the minimum distributions before you reach the age at which they become mandatory, you can possibly reduce your taxable income in the future. Now remember, a financial services professional can help you figure all of this out. You don't have to sit at your kitchen table crunching the numbers alone. Now let's talk about rollovers. In some cases, you may also be able to roll over your 401k without tax withholdings. Here's an example. You take money out of your 401k when you change jobs. Now in this scenario, 20% may be withheld to cover income taxes. Then, if you don't quickly put the entire distribution, including the 20% that was withheld, in a different retirement account, you could be slapped with income taxes on top of an early withdrawal penalty for what you've taken out. However, you may be able to avoid both the withholding and those possible penalties and fees if you directly transfer the money from your 401k to the trustee of a different 401k or IRA. Income taxes are not withheld on trustee-to-trustee transactions. Now let's move on to required minimum distributions, also known as RMDs. As many of you watching right now likely know, you're required to withdraw money from traditional 401ks and IRAs once you turn 73. The penalty for not taking an RMD is 25% of the total that you should have taken out. And don't forget, that penalty is in addition to the income tax that's also going to be required on that withdrawal. Luckily, if you notice and promptly correct the error, the penalty may drop to as low as 10%. Furthermore, suppose you're still working after you've turned 73 and you don't own 5% or more of the company that employs you. Now in that case, you can continue delaying 401k withdrawals from your current company until you officially retire. Be aware though that this does not apply to IRA withdrawals. Also, note that the RMD age will rise to 75 on the first day of 2033. Next, let's talk about charitable donations. Now, you may want to consider donating your IRA distribution to a charity. When you donate money to the charity directly from your IRA, taxes don't apply. You can help a cause that you care about and lower your tax bill at the same time. However, if you choose this option, remember that you cannot also claim the donation as a deduction when you file your taxes. Now, the last tip to help you pay fewer taxes on your account withdrawals is don't double up. Be careful not to inadvertently take 2 large distributions in 1 year. You must take your first RMD no later than April 1st in the year following the year you reach the age 73. Now from there, your next and every subsequent RMD is required before December 31st of each year. If you delay your first distribution until April, you will be required to take 2 distributions in the same year, which may mean a heftier tax bill or a nudge into a higher tax bracket. Now be sure to meet with your financial services and tax professionals to discuss strategies for taking your first and second RMDs in different tax years. Working with your financial services professional may help you build a strategy that identifies how much you can annually withdraw from your retirement accounts while maintaining your status in your current tax bracket. If you're interested in learning how you can pay less in taxes on your retirement account withdrawals, please contact our office today at retirewithbushka.com or give us a call at 715-355-4445. We'll be right back with more Financially Speaking after this.
Have you heard the term fiduciary before? According to Investopedia.com, being a fiduciary means being legally bound to put your client's best interest ahead of your own. Did you know that investment advisors have a fiduciary duty to clients, but broker-dealers just have to meet the less stringent suitability standard, which doesn't require putting their client's best interest ahead of their own? At Bushka Wealth Management, all of our advisors are fiduciaries to provide our clients more peace of mind. Call us today or go online to schedule your complimentary review.
And now our Financially Speaking weekly desk segment.
Welcome back to Financially Speaking. I'm Kaylee Berenson from Bushka Retirement Solutions and Bushka Wealth Management. Joining me is Ryan Connor. Today, Ryan and I are going to be talking about what to do with a large inheritance.
Now that's a good problem to have, don't you think, Kaylee?
I sure do, Ryan. An Investopedia article titled What to Do with a Large Inheritance offers some important tips.
That's right. And first on the list is don't count on receiving your inheritance.
I know that sounds like a bummer, but it is important. It is possible that while a will stipulates you'll get the money, something could change before you actually get it.
That's right. Your parents or other benefactor could wind up needing a lot of medical care, and the bills could wipe out your inheritance. A con artist could come along and swindle them out of their money, or they could decide to just give it to someone else.
I think the bottom line is don't count on the money until it's actually in your hands or your bank account.
Now, did you notice that the article mentions that the average inheritance size in the U.S. is $46,200 according to the Federal Reserve?
I did. That's not a huge number. That amount could help you pay off some debts, maybe, or take on a home improvement project, but it's not a life-changing sum by any means.
It certainly isn't.
The article mentions another study that puts the average inheritance even lower at $12,353.
If your family doesn't make a lot of money, you really can't expect to inherit all that much.
And that really shouldn't come as a surprise to anybody.
You're right, it shouldn't. But I do think some people are surprised when they discover the inheritance they were expecting doesn't come through, especially if their entire retirement plan was, I'm going to inherit money.
That's an easily avoidable situation. Don't assume you'll get an inheritance and save like you won't.
Additionally, you may want to invest and avoid taking on too much debt. I wonder sometimes if people run up debt because they're expecting some sort of windfall to come to them.
Oh, I'm sure people do that. And my message to them is don't.
I agree. Do not do that.
All right, so let's assume that my parent dies and I receive an inheritance. What then?
Well, the first thing to do is to take it slow. According to Investopedia, your grieving and emotions and financial decisions don't mix very well. If your loved one has just passed away, don't make any big decisions about how to spend that money. Not yet anyway.
Do my options differ based on what I inherit?
Absolutely. If you inherit cash, the best course of action may be to put it someplace safe, such as a federally insured bank or credit union.
Well, that sounds reasonable to me. Now, what if I inherit other things like securities, real estate, or other assets?
So the executor of the estate will help you get those assets transferred to your name. Remember, also, transferring assets can take time, and probate can be a lengthy process. On average, it takes 9 months, but it can take even longer.
What if I need advice on what to do with the money?
Call 715-355-4445. Now, in all seriousness, a financial advisor can help steer you in the right direction if you've just received a large inheritance and you aren't sure what to do with it. Making a long-term financial plan that incorporates all of your assets and obligations can be difficult, and a financial services professional can help you do that.
So, a financial services professional can help you decide what to do with non-cash assets, right?
That's right. And a financial services professional can help you weigh whether to add the assets to your portfolio or to sell them. There may be significant pros and cons for both options, and an experienced financial services professional can help you see the entire picture more clearly and make an informed decision.
So I've received my inheritance. I've talked to my financial services professional about my long-term plan. Now what do I do?
Next, the article recommends paying off debt. High interest credit card debt and student loan debt typically going to be the first to go. Paying off low interest debt, perhaps like a mortgage, is less of a slam dunk than clearing other debt. There may be some financial benefits to continuing to pay the mortgage. On the other hand, if paying it off and owning the house outright makes you feel more secure, it can still be a good idea.
Ryan, did you know that the lending tree says that the average credit card debt in the third quarter of 2024 was $7,236?
I did not know that. I actually thought it would be a lot higher.
Well, even so, it can take a long time to pay off an amount like that, especially if you only make minimum payments. If you have the opportunity to wipe that out with the money from an inheritance, it might be a good idea. You may be able to even save yourself months of stress and save on the interest that you'd otherwise pay.
I agree, Kaylee.
So, I've paid off my debts and I have money left over from my inheritance. Now what do I do next?
When your debts are clear, you may want to think about investing what you have left. Now, once again, the article cautions against rushing into a decision here.
When it comes to investing principles, is inherited money any different from money that you've earned?
It's not necessarily. There's nothing special about inherited money that would require you to approach investing in a different manner. The article recommends considering your entire portfolio and making sure that you're well diversified.
Should I invest it all at once?
You could invest it all at once, and it's possible that under certain circumstances that would be a good idea. However, you could also risk buying when prices are too high. Instead of investing it all at once, you could make smaller investments continuously over a period of time.
That way, I'd be able to take advantage of dollar cost averaging.
Exactly.
Ryan, can you please remind our viewers what dollar cost averaging is?
So with dollar cost averaging, you regularly buy a fixed dollar amount of a specific investment. Let's say, for example, and remember this is just an example, not investment advice. Let's say you spend $50 on a stock every month. You buy $50 worth of that stock no matter what the price is. Over time, you are less impacted by price fluctuations because you buy stock at both highs and lows. Over the time, this averages out.
That's a solid explanation. But what's next after paying off debt and investing?
Now, it's important to understand tax implications. You may not have to pay any federal estate taxes unless the estate is worth $13.61 million or more.
And what about at the state level?
So some states do levy inheritance taxes, but the estate will cut that check. You don't have to worry about it as the beneficiary.
What if I inherit other assets like securities?
So the article recommends making a note of what the security was worth on the day your loved one passed away.
And why is that?
So if you ever decide to sell the securities, you'll need to know your cost basis.
And what does cost basis mean?
So cost basis is the original value of an asset for tax purposes.
Well, that all sounds great, but what if I want to splurge?
Well, Kaylee, it's your hypothetical money, so if you want to go hog wild and buy classic cars and candy stores, have at it. However, you do have to remember that once the money is gone, it is gone, and there may come a day where you wish you still had it.
Can't I just sell one of my candy stores?
I mean, maybe that was a bad example. The point is that you can splurge if you want, but it may be wise to balance out extravagant purchases with prudent strategies like saving and investing.
So you can splurge without blowing it all.
Right, and wow, Kaylee, that conversation flew by. We're out of time. Viewers, if you have any questions about what to do with an inheritance or about your financial strategy in general, contact our office today at retirewithbushka.com or give us a call at 715-355-4445. We'll be right back with more Financially Speaking after this.
Are you looking for someone to help make retirement planning a little easier? I'm Cole Bruner from Bushka Retirement Solutions, Bushka Wealth Management, and Legacy Tax Solutions. Between our three companies, there's a lot we can do to make your retirement planning process less stressful. By creating a holistic retirement plan that incorporates investment management, income planning, tax planning, as well as health insurance and Medicare planning, you can retire with more confidence and peace of mind. Call us today or go online to schedule your complimentary review.
Thank you for tuning in to this week's edition of Financially Speaking. We're glad you were able to join us today, and we hope that you learned some useful retirement tips along the way.
On today's show, we covered a number of important topics, and hopefully we did so in a manner that was easy for you to understand. This is the same way we communicate to our clients when we meet with them in person. Remember, with the help of the right financial services professional, you can create a quality retirement, and our team is here to help. Right now might be a great time to get a second opinion on your retirement plan. Give us a call at 715-355-4445 or go to retirewithbushka.com to continue your retirement education, catch up on previous episodes of our TV and radio show, or schedule your own complimentary, no-obligation consultation.
If you have any questions or comments about today's show, call us at 715-355-4445 or feel free to send us an email at info@retirewithbushka.com. Join us next week at the same time and same place for another episode of Financially Speaking.